right, Brian, looks like we're on. I'm going to go on and kick us off real quick. My name is Ryan Cobbins, and I'm with the Energized Colorado Gap Fund, and just extremely excited and proud to bring you the Energized Community Program, which is providing funding readiness workshops, Gap Fund low interest loans, and an accelerator program to further your business. This program includes technical and business advisors to assist you with a broad range of issues facing our Colorado small businesses. Our low interest loan program is funding up to $20,000. Their 3-year terms are 36 months with an interest rate of 2.5%. So that's up to $20,000, 36-month terms, an interest rate of 2.5%. Funds can be used for payroll, rent, lease payments, utilities, debt consolidation, working capital, equipment, inventory, and also capital improvements. This program is for businesses of fewer than 25 employees in the three geographical areas that include Pueblo, Southwest Denver, East Colfax, and then childcare around the state. And so over the course of the next month, and we've been doing these for the last couple of weeks, we have a few more weeks left in these workshop programs. We're going to be bringing an assortment of information to you to prepare you to apply for the Gap Fund loan, in addition to other opportunities around the state. And so, before we get rolling, I know I've got one action item that I want folks to do, and I'm just going to post this here. And I know we're recording also. We'll figure out whether or not folks are able to see some of the chat through the recording. In any case, what I want to do now is turn things over to Brian Estrada, who's the Executive Director of the Southern Colorado Small Business Development Center. And so I appreciate Brian and his time. I'm a small business owner here in Denver and have used the SBDC for the last 12 years that we've been alive and kicking it. So Brian, I will turn things over to you. If you need anything, let us know, but I'm gonna mute out and also turn my camera off.
Sounds good. Thanks, Ryan, for that introduction, and thanks to the rest of the Energized Colorado team for inviting me. Today, we're going to go over some financial statements. Let me bring up my screen. All right, so it looks like we are on track here. So let's go ahead and make this a little bit bigger for everyone to see. Again, my name is Brian Estrada, and I am the Executive Director for the Southern Colorado Small Business Development Center. If you need any type of business assistance, you can reach out to any of our Colorado SBDCs. And so you would search in your area for your Small Business Development Center, and then you would find the location closest to wherever you are located. Right, so today the agenda that we're going to follow today is I'm going to review, on Tuesday we did a profit and loss statement. I just want to make sure that we continue to refresh everyone's memory on what these items are. And then we're also going to talk about a balance sheet and doing your projected financials, and then we'll do a quick summary. So one of the main reasons why these financial statements are important is they're created for two primary purposes. The first is for your IRS reporting, and the other is to help owners manage and grow the business as you move along and progress in your business venture. The other thing also is bankers, lenders, people like to have that information so that they can see where the business is going. Okay, so let's talk about a profit and loss statement. This is a quick example for you just to see what it is and how to read it. So basically a profit and loss statement, it is a summary of business transactions over a specific period of time. All right, it is one of the most used reports for business owners, lenders, and tax preparers. It tells us whether a business is profitable, and let's face it, that is important. It reports how money flows in and out of a business over a specific period of time. So what comes in and what we pay out, we need to keep track of. And then also these numbers would come from your tracking of daily transactions, bank statements, credit card statements, invoices, and other documents. When you're looking to do your profit and loss statement, and some of you may know it as an income statement, you would follow a standard format. And that standard format would be the company name and dates that are included in the statement. So if you're doing it on a monthly basis, it would be, let's say, April 1st to April 30th, and that's what you would show. Okay. It also has a list of your chart of accounts. It has a revenue section, your cost of goods or variable expense section. It has an operating expense section. Then you're also going to want to be able to read your net income, profit, or some people call it their bottom line. Whenever you're thinking about your profit and loss statement, you want to follow a simplified equation. And this is so easy to remember. It's just revenue minus expenses equals your profit or your net income.
Hey, Brian, if I can jump on, they can't see the P&L. They're just seeing the PowerPoint right now.
Yes, that is all I'm showing for that one.
Okay.
It's just a quick overview today.
Okay, thank you.
Thank you. Okay, so let's dive into what today's portion covers, and it's the balance sheet and financial projections. Okay, a balance sheet, it's a snapshot of the financial condition of your business on a specific day. Okay, the balance sheet is usually done at the end of the month, so we can take a look at what is happening. It's not showing all the cash flows for a quarterly basis or a monthly basis like the profit and loss statement did. What this is, it's just giving a snapshot of the financial condition of the business today. So it tells us how much a business was worth on the date that it was created. It's a statement, like I said, it portrays the strength of a business. It lets us know this business is really worth it. Does it have the ability to continue as an ongoing concern? Can it pay off debt? Can it survive any threats that may happen as the business progresses? It tells us whether or not owners have equity in the business. It'll also tell us if a business is considered upside down. This means if it owes more than it owns. So if a business owns on its building, it owns on all its equipment, but it doesn't have any savings or background to cover all those expenses and the amounts coming due, then that business is considered upside down. And that's important for you to know so that you can look at ways to pay off debt, to increase revenue, and then you can start a new plan. And we'll kind of talk about that when we go over financial projections on how you can come up with a new plan. The balance sheet also has a goal. The goal is to strengthen you strengthen your balance sheet, by increasing assets and paying down debt. When you focus on this practice, it builds a resilient business. Okay. For those of you, if we think about equity, that's assets. We'll talk a little bit more about that. But debt is generally considered a business risk unless it is used to purchase income earning equipment. So if you're operating your business, you don't want to have a lot of credit cards or accounts payable that you have to pay out, things like that. You want to try to make sure that you're operating with the cash flow that's coming in. And if you have a loan, it could be for the building, it could be for large pieces of equipment. You want to make sure that you're trying to keep your debt lower than what you actually own. Okay, when we continue on the balance sheet, and I'll show you guys some examples here in just a little bit, but this is what the balance sheet is telling you. It tells us the value of assets, and assets are what we own, and it shows what we have invested in the business. So we have short-term assets, which are cash, our inventory, accounts payable. The reason that these fall under short-term is because we can collect that money pretty quickly, or if we had to sell it to pay off other things, we can quickly convert that to cash. Okay, fixed assets could be real estate, equipment, vehicles. Let's say you have a restaurant and you needed to buy a new stove and new dishwasher and things like that. That is your equipment that you own, and that shows as an asset for your business. And individuals, when they're reviewing your financial statements, they do take the time to check out what your assets are. So you would want to make sure that you do list that. Okay, it also tells us how much debt a business has. Same format, short-term debts are usually your utilities. You can say upcoming payroll. These are any debts that will come due within 1 year. So those are your short-term because they'll be off your books here pretty quickly. So that's what you want to keep track of, what is actually a short-term debt. And then we go into long-term debt. Any bank loans that you have, payments on equipment, you're buying your building. Let's say you didn't take out a bank loan to buy your building, but you're doing something with the owner and it's owner carry. You would list that as a payment that you're taking care of. And then quick and easy way to think about it is a long-term debt is any other debt that will not be paid off within that year. It'll be something that will be ongoing and you have to plan for it. Okay. When you're looking to collect the information from your balance sheet, it comes from a variety of sources. Again, it comes from bank statements, credit card statements. It can come from your accounts payable records, net income or loss from the profit and loss statement that we just did a quick overview on, and then your inventory records. Okay, you want to make sure that you have all of this information readily available so that you can pull that data. For those of you who have a business that does have a point of sale system, which is great, a great tool to have is the fact that you can run these reports just from your POS system as long as you are entering your data on a daily or weekly basis. So you want to track your sales, you want to track your purchases, you want to track your payments, you want to track everything, every transaction that goes in and out of your business so that you know what is happening on a day-to-day basis. Okay, a couple more things when we break down the balance sheet. When you're setting it up, you want it to make sure that it has these sections so that your financial person that's looking at it, or even your accountant or yourself, it's going to have all of this so you have the records. Let's say you get audited and you need to pull your balance sheets. The IRS wants to be able to see your company name and the date that it was created. Okay, so if you're going for a loan, you would want to have your 12 balance sheets so they can see how it changed each month. Then you're going to have an asset section, and that's what the business owns. You want to break this down into current assets or fixed assets. And current assets, again, are those that can be converted to cash quickly, such as bank account, savings accounts that your business has, accounts receivable, invoices that you have outstanding with customers. You can get that cash pretty quickly by making a few phone calls, collecting that money. Your inventory can be converted into cash as well. Fixed assets are those that cannot be quickly converted. So real estate, heavy equipment, vehicles, etc. Okay, then you're going to have a liability section, and this is what the business owes. So again, current liabilities are those items that will come due within the next 12 months. So if you're ever, let's say you're closing a business or you're selling it, that's the first thing that they will want to look at is how much of this debt is going to go away, and do you have enough of that debt do you have enough in owner's equity or your assets to pay off that debt? Okay, long-term liabilities is money owed on large loans, such as mortgage, vehicle payments, any other loans. You may have taken out a loan to start your business. You know, how much longer do you have on that to pay for that? Final part of the balance sheet is the owner's equity. This is what is left after you have subtracted all of the liabilities from the assets. So quick, simple equation here as well is total assets minus total liabilities equals your owner's equity. So here's two examples of different types of balance sheets. Okay. So the first one, you can see that they have it set up where they show their assets and they have current assets. So in this case, they have a checking account for 5,000. There's savings account with $1,000 balance. In their office or safe, they have petty cash of 500. They have $22,000 outstanding that customers owe them. And currently they're carrying $15,000 in inventory. And then they went ahead and they prepaid their insurance. And yes, that's an asset. So altogether, they have total current assets of $49,500. Okay, then we go on and we're looking at non-current assets. Okay, here we are tracking our accumulated depreciation because in every business, as we buy pieces of equipment and we use it, it tends to depreciate. We're not going to be able, if we bought something for 10,000, we're not going to be able to sell it 10 years later for 10,000. And then we also need to show and remove that from our financial statements. So this is some depreciation. However they have it set up, I don't know on this particular thing, but you work that out with your financial advisor, your accountant, your bookkeeper. They'll give you a good estimate of what your accumulated depreciation rate should be for any large pieces of equipment. Okay, they also have computer systems of $7,000. They have building of, I think that's 65. I'm sorry, it blurred out when I made it a little bit bigger here. And then they have land of 60,000. So total non-current assets, 127,000. So altogether, that is $177,000, I believe. Like I said, sorry, it's a little blurry on here. Then we go to the liabilities and equity. Current utilities are accounts payable, 12,000. Line of credit that we have that could be paid off pretty quickly, 20,000. Payroll liabilities, 7,000. So total current liabilities here is $39,000. Non-current liabilities, long-term debt is their loan. That is 45,000, I believe. So then we have, I know that's not 47,000. I'm sorry, you guys. $48,000. Okay, so we have a total liabilities of 87,000. Then we've got our equity. Okay, owner's capital. The owner has invested $25,000.
Ryan, sorry, I'm going to interrupt and check with you again. Are we supposed to be seeing the document you're looking at?
Yes. Can you see? Are you seeing two balance sheet examples?
We're seeing the slide deck now. Still.
What slide are you seeing? I apologize.
We're just seeing the intro slide on the PowerPoint.
Oh, none of them moved at all?
Mm-mm.
Okay, it's moving on my screen. Sorry about that, guys.
Financial statements 101.
Okay, well, let's go back here.
There you go.
There we go.
Okay, all right. So for some reason, it's not moving again. So I apologize, everybody. It's moving on my two screens here. So since you weren't able to see that, let me just go through these real quickly again. So I do apologize for that. So like I said, we are going to review the profit and loss statements. Part two, we're going to talk about the balance sheet and projected financials. So again, your financial statements are created for two primary purposes. IRS reporting, and to help owners manage and grow the business. Okay. A profit and loss statement, it is a summary of business transactions over a period of time. So like I said a minute ago, it is one of the most used reports for businesses, owners, lenders, and tax preparers. It tells us whether a business is profitable. It reports how money flows in and out of a business over a specific period of time. The numbers come from tracking daily transactions. The standard format of a profit and loss statement includes the company name and dates included in the statement, the chart of accounts, a revenue section, cost of goods or variable expenses section, an operating expense section, your net income, or AKA profit or bottom line. And again, the simplified equation for this is revenue minus expenses equals profit or net income. So let's look at our balance sheet one more time. All right. As I said, a balance sheet is a snapshot of a financial condition of a business on a specific day. Whereas the profit and loss shows the flow of money in and out of the business over a period of time, the balance sheet will show us the financial situation on the date that we created it. So it tells us how much a business was worth when the balance sheet was developed and put together. It also gives us a statement of financial condition that portrays the strength of a business. It reflects the business's ability to continue as an ongoing concern, to pay off debt or survive a threat. And in today's world, that's very important. It also tells us whether or not owners have equity in the business. Do they have a major investment in this business? A business can be considered upside down if the owner's equity is negative. This means that it owes more than it owns. The goal, while we're looking at this balance sheet, is to strengthen the our goal for the balance sheet, is to make sure that we increase assets and pay down debt. This practice builds a resilient business, and debt is generally considered a business risk unless it is used to purchase income earning equipment. When we talk about income earning equipment, think of, like I said, dishwasher, vehicles. I always use a restaurant example because that's my favorite thing. So delivery trucks, dishwashers, stoves, etc. Okay, when you're looking at your balance sheet, again, like I said, it's a snapshot and it's broken down into 3 sections that it really shows the most information here. So the first thing that we do is it tells us the value of assets. So again, short-term assets, anything that we can collect pretty quickly. So that's cash, inventory, accounts payable. Fixed assets, real estate, equipment. Okay, it also tells us how much debt a business has. Again, we break this down into short-term and long-term debt. So we call those liabilities. Again, short-term is utilities, upcoming payroll. So we want to make sure we remember is that when we're thinking of short-term debts, it's anything that can be paid within 1 year or 12 months. Long-term debt, bank loans, and things that will be on our books longer than a 12-month period. When we're trying to find the information to collect for our balance sheet, this comes from bank statements, credit card statements, accounts payable, net income or loss from your profit and loss statement, and also your inventory records. So when we're doing our balance sheet, it should be broken down like this. It should have your company name and the date created. So the example I gave earlier was, like the profit and loss is April 1st through April 30th. So this would say, let's say we're closing our books. So we are creating our balance sheet on April 30th. It should have an asset section. This is what the business owns. Current assets are those that can be converted to cash quickly, as I stated earlier. Bank accounts, accounts receivable, inventory. Fixed assets are those that cannot be quickly converted, such as real estate, heavy equipment, any vehicles. Those would take longer. We'd have to sell. They can't be converted to cash, and generally we will owe money on those. So that's why they're considered a fixed asset. The liabilities section is what the business owns. So again, current liability, or owes, not owns, sorry. Current liabilities, liabilities that will come due within the next 12 months. Long-term liabilities are money owed on long-term debt, could be mortgage, could be vehicle payments, or any other loans that you may have gotten that are longer than a 1-year term. Owner's equity, this is what's left after you've subtracted all of the liabilities from the assets. Simple equation for you is total assets minus total liabilities equals owner's equity. Okay, so let's look at these examples again so that we can talk about, so you can see what would be included. So I've given you one example that just shows you a completed balance sheet. It goes through the current assets, and as I said, it showed what our checking account balance had, what our savings account, what our petty cash had. And so our total current assets, it looks like we're $49,500. Then our non-current assets, again, the accumulated depreciation is shown here. Your computers, your building, your land. When we add those two numbers together, it gives us $177,000 in total assets. Then when we take a look at our liabilities and equity, again, we want to break down our liability into current liabilities first. This is our accounts payable, our line of credit here, our payoff, our payroll liabilities right now, what we would owe. So again, when we add all those up, it's a total current liabilities of $39,000. Then our non-current liabilities, our long-term liabilities, as how I remember it always, is like your long-term debt. And again, in here we have another, we have 48,000 it looks like. And when you add those two together, it's $87,000. So then when we look at our equity, this is what we have as owners in our business. So we have owner's capital, we have 25,000 here, and then we have retained earnings. So we've kept some of our money when we've made profit, and we keep it so we can use it to help reinvest in our business or grow our business. So when you add those together, our total liabilities and equities equal 177,000. So they balance, hence a balance sheet, all right? We always want to make sure that when we're going to a financial institution or when we're talking to the IRS, that our assets and our liabilities balance, okay? Because we do not want to appear upside down where we owe more than what we own, okay? The other example here for you is a sheet that you can fill out. All right, again, it lists a few things that are the basic assets. You can get these templates from your POS systems. As I mentioned a few minutes ago, you can download them. You can create this on an Excel file. If you want to, you can use Google Docs to create a system. If you utilize QuickBooks, these will automatically be generated for you. There's programs that take care of that. And your bookkeeper will take care of this for you if you are paying a bookkeeper. All right, what are financial projections? So that's the next thing we need to talk about. These are financial statements that forecast the future, okay? We want to look at what do we think our performance is going to be as we move forward, okay? unlike the P&L, the P&L reports the past and what's happened. This is what's going to tell us what we think is going to happen in the future. And that's what, when we're going to speak with lenders, when we're making our business plan on what's happening over the year, we want to be able to say, we believe this will happen. So the projections are extrapolated or gathered, you can use gathered, from past operating data and other sources to provide what I call, and most of us call, because it is just a projection, it's a forecast, it's your best guess scenario as to what your future business performance is going to be. So now with inflation increasing, we've got to look at what's going to happen to our business in the future. My expenses are going up. Some people may reduce the spending that they do. So you've got to adapt for that. So you need to be able to pay attention and be aware of what is happening outside of your control. When we're in situations like this, we can try to control certain expenses, such as we can control utilities, we can control inventory amounts, we can control some aspects of our payroll. So that's what we want to take a look at. We can control future loan payments and things like that because we won't borrow much money. So we want to know how we can put this plan together. Okay. Financial projections are usually used primarily by lenders and owners, like I said, to make decisions about future cash flow and investments. Okay, so it's not just a tool for you, it's also a tool for your lender to take a look. When you're creating these, it's best to be conservative. Be realistic is what I say. If you think something is going to generate, I'm going to use small numbers. Like if you think something is going to cost you $5 and you can sell it for 10 and you think you're going to sell 1,000 of those, all right, is that price realistic? And that's what you want to make sure. You don't want to come off and say, oh, I can make this item for $5 and sell it for 20. Okay, because you don't want to over project and then not meet what you're saying your projections were. Okay, and then always make sure when you're putting these financial projections together that all your assumptions are clearly stated along with the accompanying projections that you're doing. You want to make sure that they understand what you have thought of or what you're assuming. So general, whenever we're doing a budget or a forecast for the next year, we would estimate 7% sales increase. Let's say we're in a very highly populated up and coming neighborhood for our restaurant. So we want to say we can see a 7% sales increase. Okay, but then we also got to estimate for possible 3 to 4% increase on our cost of goods. So we need to make sure that we list all of those assumptions. So always remember, it's not just the revenue that's coming in, it's also all your expenses. So you want to make sure that you look at that. I put a big reminder here is, as a business owner, it's important to understand the value of this information because you really need it to be able to make those decisions for the future. Someone told me once that you wouldn't fly an airplane blindfolded, but many business owners try to run their business without really having an understanding on the financial side. And I come back with it saying that, well, they're taking care of the day-to-day operations, and that's why sometimes they have to utilize a bookkeeper or an accountant. But it does make sense. You have to be aware of what's coming in and what's happening with your business. So whatever's coming in, what are you also paying out? You need to be able to take a look at that. So I always say, take the time to educate yourself on the financial side of your business. It's probably one of the best investments that you can make into your business. Okay. So I found a simple example that can show you. This one is showing information from the income statement, or again, the profit and loss. And then it's also showing some items from the balance sheet. So anyone who has been in business, they have their data that they can put into year one. and that would start. And then you can see here where they listed their assumptions. Okay. In this particular example, they kept their gross margin pretty steady. They didn't plan for a large increase in sales. They have their assumptions where their depreciation is 20%, and their finance costs is 4%, and then income tax expense, again, that they would have to pay out is 20%. So they went ahead and in year one, they had 40,000 in revenue. So they came along and they said, in year two, we think we're just going to increase our sales. They just came up with a number. So they said, we're going to increase our sales by $35,000. Our gross margin is still the same percentage. They've kept that consistent. Okay. And so then you can see how their cost of sales changed each year as they made this projection. Okay. And where they probably got this data, because you can see that they increased the next year by only 25,000. So there could be something that's going on in their area that they're aware of. So it may affect the growth. But then they feel that they're pretty established. So they want to increase their sales in year 4 by another 100,000. And then they think they can do that in year 5 by another 100,000. So either their business is growing, it's in a good area, they have new revenue streams coming up that they think will add to their sales. So there's all these factors. So when you're planning this, I always tell people, keep some notes on the side so that you can submit that with your projection sheet so that you know what you were thinking is going to happen. And then that way you can be able to refresh your memory and come back and see what you actually planned. And is it working? That way you can go back and check. And if you have to, you could revise this. So they went ahead and added their accumulated depreciation for all their equipment. They've added all and subtracted things that they need to, and this shows where their net income is coming from for over the next 5 years. Okay. They also took a look at their balance sheet so that they can project their balance sheet. And again, they listed their assumptions. They have opening balances. And then again, they've gone through what they see will come from their first financial projections so that they can show how their assets and liabilities will react to the changes that they're doing as the business goes on for the next 5 years. Okay. So in summary, the profit and loss statement, the balance sheet, and projected financial statements have guided business owners, lenders, and tax preparers for decades. Understanding and using them will increase your odds of building a successful business. Okay, so this is the end of my presentation. So I gave my contact information here and my website. If you did have any other questions or you needed to find an SBDC in your area, feel free to reach out to me, and I'm more than happy to help. So I'm going to stop sharing my screen.
Brian, that was awesome. Thank you.
Thank you. Okay.
So we haven't had any questions come in, but I would love if anyone has questions, please drop them in the chat or in the Q&A. Brian has so generously given us his time. So I want to make sure any questions that come up, we are able to answer.
Okay. And then just since we had that technical difficulty there, I apologize. I should have known better that when you do the full screen, sometimes it works, sometimes it doesn't on Zoom. So I'm just going to stick with my old way, keep it here. But I will send this to the Energized team, and then they can forward it out to anyone who needs it. So I will send that here shortly.
Great. Really appreciate that. And we don't have any questions. So, oh, here we go. Brian, can you see the questions or would you like me to read?
Yep, I can. Okay. Let me just pull it up here. I can do it under the Q&A, right? Oh, wait. No,
nope, they're coming in under chat.
Okay, I will pull that up. All right. Okay, so if you have a farm business, the feed and hay costs would fit into your inventory because it is a cost of goods to generate your business. So that's where I would keep it. And I would also keep it, if you're putting it in the balance sheet, it is a current asset. And then any bill that you owe out of that is also a current asset. When you're doing it under your profit and loss statement, it is under your cost of goods. So the cost of doing business. Okay, the other question is, can you please tell me how to find a qualified and experienced accountant that knows how to work with small businesses? Okay, what I would do, you're not the only one who is having a hard time with that right now. Accountants are so burdened and they're experiencing all the same things that small businesses are right now, of having a hard time finding employees. As everyone calls it, the great resignation is really starting to have an effect on us. So what I would do if I were you is I would reach out to your local SBDC because they can refer you to these businesses, and then take an extra step. If you have a chamber or an association in your area, they also have names of businesses that you can reach out. And I'm going to tell you this is, take the time, don't take the first one that you get. Call them, interview them, see if they will work with you and if it's a good fit, because you may need to go to more than one bookkeeper or accountant. So I'm sorry I can't give you any more definite area, but that is really what you should do to look at that. And then the other way to find that out is if you're involved in any networking group, or you're walking down the street and you see a small business, walk in, ask them, say, hey, who does your books? And they will, a lot of people, if they have someone good, they're ready to share. Think of it like when we get a haircut. If we like somebody's hairstyle, we go and say, hey, who did your hair? And it's the same thing when it comes to bookkeepers and accountants. All right. Let's see, Emmanuel, I would like to know if business falls under East Colfax quarter. Okay.
Yeah, so I can answer that because that's for, I think, our Energized Community program. If you message Ryan, who's unable to get on video right now, I'm dropping his email into chat. He can very specifically look up where you are and let you know if you fall into that area. So feel free to reach out to him directly.
New livestock, I would keep it in your long-term assets as well, because you're not going to get rid of a livestock. I'm just going to say cow, because that's the first thing that comes to mind. You're not going to get rid of a cow that quickly in 12 months. So that's where I would keep it. If it's like chickens and things that are going to move quickly, then I could keep some of those in my short-term assets, because they're going to be gone pretty quickly. So that's what you need to look at when you think about that. Rebecca's laughing at me. She actually
I'm
knows
laughing.
about
I'm impressed
livestock.
with your knowledge of livestock. I would not have been able to specify where your animals go on your balance sheet. So thank you.
Well, when I'm looking at, the good news is I have a lot of farm friends because I do live in rural Colorado as well. And so that's where I know chickens, some may last 2-3 years, but they've got a good laying time of just about 1 to 2 years. So you need to look at that. And then I learned something new about sheep, that they don't keep them around that long either. But for the time being, when you're getting the new livestock, I would definitely put them into your fixed asset spot. Okay. All right. Let's see. I have interviewed 3 and hired 1, but they don't know what they are doing. Okay. See, that's the same thing that we're saying. If you do have enough funds, okay, and you can afford, I know I'm not supposed to really like promote anything, but if you can afford something like QuickBooks or like a Square system or POS, these will run all of these reports for you. And then what you would only want to do is at the end of the year, you compile all that data and then you take it to someone to do your taxes. You can do things for yourself on a monthly basis if you use the system. So it is an investment, but I would definitely look at it because it may save you some stress and some pain in the future. So that's something I would definitely take a look at. And so looks like all the questions.
That is all the questions. I would also add Brian's SBDC, all of the SBDCs have business consultants who can help you with these documents. They can't create them for you, but can absolutely walk you through making sure you have everything you need for to apply for a loan or just to have these documents for tax purposes,
Yes.
whatever you need. I'm also dropping a link in the chat now to our EC Hub, and we can connect you with business advisors as well, or we can connect you with the SBDC in your area. So feel free to look for someone in there, and we'll figure out if it makes the most sense for you to connect you with one of our advisors or someone closer to your area, depending on where you are or with your specialty. So please don't hesitate to reach out to Brian, to anyone at Energize Colorado with any questions about creating these documents, because
Yes.
it can be overwhelming.
Yep. And someone put they're giving a recommendation or a referral for an accounting service in the chat. So check that out as well. See, it's word of mouth. That's what definitely helps and makes it worthwhile. So again, sorry about my technology hiccup there, everybody, but I hope it was useful information.
Thank you. Thank you so much, Brian. We're so grateful for you. Thank you, everyone, for attending. We will send out a recording to make sure that if you'd like to review this, you may. And we look forward to seeing you at our next sessions. So thank you.
Take care.
Have a good night.